It's a very volatile time in the markets. It's at times like these that a lot of investors lose faith and want to redeem their mutual fund investments. But we want to get you a view as to how you should be looking at retaining the funds in your portfolio. All-weather funds, what is the outlook? What are the top picks? As well as what the outlook is on dynamic asset allocation, balanced advantage funds. Who better than Dhirendra Kumar to break it down for us? And good morning. Good to have you on board, Dhirendra. Let's just start off then at a time when sentiment is at a low. We're talking about the acute volatility in the stock markets. All-weather funds really seems to be the right approach. Can you elaborate a little bit more about this?
No, all-weather fund should always be the right approach. Good times, bad times, for the simple reason that mutual fund investors are, for them, investment is a very peripheral part of their vocation. People are busy working, making a living, and the savings should be put to work. The basic hurdle should be, the basic goal of any investment should be able to beat inflation and then optimize return as much as possible. And so with that in mind, if you actually complicate, if you look at it as a very complex exercise, then you will not achieve your goal. Your goalpost will be changing. You will always be anxious because market is always in a different state. Either you are excited about it or you are scared of the market. You will never get an opportunity. You will end up mistiming it. Simplifying your approach always helps, and you have far greater control on what you are doing. So uncluttering your investment, and that is why you should have funds which are all weather. Good times, bad times, they should be valid investment. They should be, you should not be getting attracted to what has done well in recent times. That is generally the starting point of investors. So all weather should be the top priority or should be core of any investor's portfolio at all times.
Dhirendra, morning firstly. Would you say that all-weather funds do stand a chance of a muted performance as opposed to what large caps or concentrated, perhaps mid or small cap funds can do, or would you say that's not quite the case?
Over a period of 5 years and more, you end up earning similar return without the anxiety. But in the short run, you will have a situation like if somebody was investing in 2017, one might look like fairly deprived if one was not investing in small caps and mid caps. But subsequent time, the cyclicality, the reversion to mean, the cyclicality of market actually catches up. So long-term investors should try and keep things in a manner that requires least of intervention. It should be a low maintenance investment activity, and over a 10, 15, 20-year period of accumulation, the difference in having a very aggressive portfolio at different times, concentration can translate into superior return in a period of time. Likewise, concentration in a certain sector or by certain capitalization can enhance return. But the reverse is just as true. When you get 70-80% return in small caps and then you see the free fall, I think on a 3-year basis it turns out to be the same. At the same time, but that roller coaster ride that you have there might not be worthwhile, and that is something which investors should appreciate, and that appreciation normally happens after somebody has invested for a full market cycle, a phase of rise as well as fall.
Okay, fair enough. Given that you said that, these all-weather funds really should be looked at all times for all kinds of investors because they do perform well in unfavorable market conditions, I'm sure a lot of investors and people watching are curious to know what are your top picks, because you've broken it down in terms of the value-oriented growth as well as equity-oriented hybrid. Can you tell us a little bit more about that?
Yep. Yeah, I think the equity-oriented hybrid funds, which invest nearly 3/4 of your money in equity. So they are equity funds. 25% of the money is invested in fixed income, and I'm a great believer of something which is static. By allocation, it turns out to be it's an equity fund with shock absorber. And investors are driven out of the market in a declining phase simply because they were just not ready. If most large number of investors get attracted to equity linked investments in a good market, and when they see the first decline, they were not prepared for it. Whatever may be told to them that it is mutual funds are subject to market risk, equity is very volatile. Despite all that, when you actually see it happening with your own money, you are driven out of it. So they turn out to be a superior, a steadier take on growth. And so equity hybrid should be the starting point. It's an all-weather simply because the equity allocation 70-75% is fairly generally multi-cap, and 25% fixed income provides you all the stability. So I find them to be a reasonably good all-weather alternative, valid for most investors, anybody investing for 5 years and more. Then comes little more conservative all equity option. There we have ever since the classification where funds have slotted themselves into different category and committed themselves to conduct in a certain manner. I'm beginning to value funds which actually show far greater resilience in a declining market. They have and they have, many of them have been able to build a very solid case for themselves. They have long history. In fact, all the fund that is part of my selection, they have been through at least 2 or 3 market at least 2 market cycle, and they have shown more than doing far well in a rising market. They show far greater resilience in a turbulent market. So value oriented multi caps, they turn out to be the second alternative. And third is a multi cap fund, plain vanilla multi cap fund, where all your money is invested in a manner and it is spread over large cap, mid cap, small cap, as well as and dominantly growth. These are the alternatives. If you are able to build a portfolio of 1 or 2 funds from any of these categories, you will be you'll be able to beat inflation. And I'm sure the regularity of investment, the SIP, the accumulation phase, if you are doing it regularly, you will be able to beat the market as well over a period of time, simply because that will be the reward for your own discipline.
The dynamic asset allocation funds, Dhirendra, you can invest in a mix of debt and equity. At a time like this, would that be a prudent strategy?
Yeah, I would say that those are the new classification actually provides for a balanced fund, which is 50% equity, 50% debt. That should have been a superior alternative. Dynamic, the balanced advantage or the dynamic equity allocation, not too many funds have been able to build a great track record. I like funds for what they deliver by design: diversification, active management. But active management by building a portfolio of diverse, a good company is one part of the story. The other part is taking a call on the market and allocating the assets into equity or debt. I haven't come across too many fund managers calling it right, and they have not been able to build a great case for themselves over a long period of time.
What are the advantages then of looking at balanced advantage funds?
Balanced advantage fund got created entirely because of tax break which was available. These funds were actually balanced funds, 50% equity, 50% debt, but they were able to pretend that they were equity oriented fund because our tax laws provided for, tax laws define that a fund will be treated as equity if it has a 65% allocation to equity. So these funds actually provided for 15 to 20% equity arbitrage, which is almost by its character it is fixed income, and legally it actually looks like, optically it looks like, from the taxation point of view, looks like an equity fund. So it was actually a tax loophole, not loophole, but tax enablement, a definition which the funds were trying to leverage. Ever since the abolition of, ever since the long-term capital gains on equity has been done away with, now we are subject to 10% capital gains tax. I really wonder that that tax case for that is as strong. I think investors for the long run, should be focused more in terms of choosing good funds, having the appropriate allocation so that they can stick around for a long period of time, and keep it simple and stick to their disciplined approach to investments. and not get, and not getting too much carried by the swings of the market, which is either in exuberance or scary. That itself is the single biggest advantage for individual investors.
All right. Thanks very much then, Dhirendra, for joining in and giving us your views as well as your top recommendations in terms of which funds could be looked at. All-weather funds, simple, manageable, definitely need to be in your portfolio. And good equity funds with a shock absorber. That's exactly what balanced advantage funds are. And of course, Dhirendra has slated out his top picks. Okay, moving away from mutual funds, let's connect then with the management of Minda Industries. They're here to talk a little bit about the misery that we're seeing in Motown. Is there any hope amid the transitory troubles? Any revival? Can that be seen? Well, joining in right now, we have with us Sunil Bora. He is the ED and Group CFO of the company. Thank you for taking time out and joining us on ET Now. It's fairly challenging times for the sector as a whole. Give us a sense as to what exactly the industry is pinning their hopes on, because there are talks of some sort of a reprieve coming in, some tax breaks. What is it that you want to hear?
Oh, definitely the times are tough. Nobody sort of envisaged this a year back when we started seeing that the weather, the wedding season, the Diwali season was not so good, and post the ILFS thing, everybody thought that in 1 or 2 quarters things will stabilize, but things didn't pan out as we thought for, and we are seeing almost volumes which are low in sort of 2 decades. We have not seen this kind of drop in volumes. So obviously these are tough times, challenging times, and these are times to tighten our belts, do a lot of things which we normally don't do, like really looking at your capex, your growth plans, tightening in terms of your expense cost management. So we are not leaving any stone unturned, and I'm sure that's the story of the industry, to stay afloat. And I think the toughest will survive. And this is I would say, a time when everybody is sort of trying to work with each other rather than pulling each other down. We are trying to work with everybody to see that how we relook each and every aspect of our costs, each and every aspect of our customer need. How do we make sure that this time, which is the lean time, we utilize for a lot of improvements, upgradation in the system, quality, etc., etc. So I think we are trying to make the most of it. At the same time, we are trying to see that we maintain our margin and we maintain our market share, and see that consistently the path which we have set ourselves a year or 2 back, we want to stay on that track, and we don't want to lose our focus. And that's the key reason we are still going ahead with our capex, the greenfield capex plan which we have laid out for ourselves. We will be still in this market, we will be spending capex of close to 400 to 500 crores in this year. A bulk of it is towards the greenfield capex, and we firmly believe that the long-term story of the country in terms of growth, in terms of the potential demand still there, while these are the headwinds, and I'm sure every industry sees these headwinds at one point or another, while this time the headwinds are much stronger than we thought of. But I think we will come out stronger, and as an industry, we will do much better once this phase passes off.
Also wanted to understand what really, Sunil, is the contribution from the value-added products. Is there a scope to grow their volumes given the regulatory changes, safety norms, BS6, etc.?
No, definitely there is potential to upgrade, to premiumize the products. Like in lighting, we are seeing it specifically in two-wheelers, the normal halogen lamps being upgraded to LED lamps. Because of BS6, while in terms of our product portfolio, we don't have too many products which are directly linked to BS6, but wherever they are, like filters and all, there is obviously a value uptick, and that's why you see that the industry is definitely expecting the costs of the vehicle to go up from BS4 to BS6 transition, maybe higher for a diesel vehicle compared to petrol, but this is the journey which we all have to live with. And I think we are fortunate enough to see that most of our products are agnostic to the fuel injection system. So that way we are also protected to a large extent.
But tell me, what's the margin visibility if the share of value-added products does improve further? Which are the new products also with most potential in terms of both demand as well as profitability that you foresee?
Yeah, in terms of margins, as you know that we have obviously tightened our belt over last 3-4 years. We have moved our margin range from 8 to 9% to close to 12% last year. And at the beginning of the year, we were very confident to meet our margin range of last year, which is 12 to 12.5%. And our first quarter numbers were broadly in line with that number. We are happy that we are able to maintain those margins despite the pressures which the industry is seeing. We are at 12% in Q1, and we are quite confident that we should be able to maintain this broad margin range for the rest of the year despite whatever the industry is currently witnessing. In terms of our new products, as you know that we have currently in process of 3 new products which we are currently putting greenfield facilities, which is the alloy wheel for two-wheelers, the controllers and the sensors. And in terms of margin, we do expect the margin for those new products to be broadly in line with our existing product portfolio. We don't expect any significant bump up because while we are adding 3 new products, we already have almost 30 products basket, which is averaging at 12%. So the 3 new products definitely we don't believe to be significantly increasing our margin profile.
Okay. Several analysts have continued to be a bit cautious about your growth in the near term due to the auto sector slowdown. Just give us a sense on how you feel the second half of the year will pan out. What are you sensing on ground?
Oh, definitely there are a lot of expectations from second half perspective. With the good monsoon which has picked up of late, while obviously the large part of the few states is submerged underwater, and which is not a good news, but obviously in the medium to long term, when this phase passes away, obviously the kind of rains we have seen will definitely lead to good agricultural growth, and that will expected to have a better weather and better season demand in the Diwali this time. Plus in second half, what is the expectation is that people who have been deferring their purchases, there is a general expectations that when we have moved earlier also from BS3 to 4 or 2 to 3, there have been general demand uptick happening. People who have been deferring their demands, who have come to market, or people who are sort of preponing their purchases to come to market because the likely increase in the cost from of migration from BS4 to BS6. So definitely there is a lot of hopes built in H2, and we are geared up to sort of meet those demands, and we are quite confident that second half will be much better than what we have seen the first 2 quarters.
Fair enough. Thank you for sharing with us the outlook, saying that yes, there is a slowdown that is very much evident, but they will have to bear that and come out stronger on the other side.